So who borrows from Yieldstreet and why do they choose us as a partner? I'd say a couple things. One, any operator who's looking to close on a transaction quickly and efficiently would come to someone like Yieldstreet. We are flexible, we can move fast, and we have a captive capital base that we can move fast on and execute and close. That's the first thing. I'd say the second thing is that with the increased regulatory environment, a lot of borrowers do not want to deal with banks. There's other background checks that may be required. There's other KYC, know your client background checks that are often done. It's cumbersome, it's slower, and it's inefficient. We think that we can come in as a lender and be more efficient, be quicker, be easier to deal with while still protecting our investors and ensuring that we structure the most optimal loan for that particular product. Banks just can't do that as quickly as we can. I'd say in addition to that, we are targeting a shorter term loan product. For most banks, given how slow they are and how big they are as organizations, they probably prefer a longer term duration loan. Whereas we're open to doing 3 years and below, 4 years and below. There's not as many banks that will lend on that duration spectrum. The question always comes, how does Yieldstreet structure our deals? I would say we have three different buckets of lending in the real estate space that we currently engage in. The first one is first mortgage bridge loans, second is mezzanine loans, and the third is pref equity. I'd say 90% of the business we've done today has been in the first mortgage bridge space. That typically looks like the following: 3-year term, 70% LTV, full personal guarantee, and call it L plus 550 spread context over LIBOR. We think we're competitive in that space. We think we can move quickly and provide our borrowers with a very good business relationship to grow and scale. And we've been successful doing that 30 times in the last 2 years. In addition to that, we have the mezzanine sector and the pref equity sector. And that's been a focus of ours to grow over the last 6 months or so. And we hope to do that going forward. What makes those attractive is you often can get more attractive yields, but you're also going higher in the leverage part of the stack. You're going up to 80% versus maybe 65 or 70% in a first mortgage loan. The overarching theme around lending right now is the low interest rate environment. When the 10 years under 2%, LIBOR is at 1.65%, there is a grab for yield. The key that my job has to entail is ensuring that we are not seeking just yield at the expense of putting our investors at risk. Every day I walk in the door focusing on that topic. How do I ensure that our investors get their money back? They're protected with a good risk-adjusted return, and that's what we do every day. So what types of qualifications do we look for in an originator? I'd say the first and foremost is a proven track record. They have the experience of investing in both an up cycle and a down cycle in the real estate markets. I'd say secondly, it's the ability to invest across different property types: office, industrial, multifamily, retail. Those are really important because you want to be able to have the ability to access all those asset classes. The track record, we mentioned about just different cycles, but also the ability to kind of play in different parts of the cap stack. To the experience in mezzanine lending, the experience in first mortgage lending, pref equity, maybe even equity. Whether their specialty is in one part of that cap stack, we want to focus with that particular originator in what they're best at and focus on that product. I'd say third, and probably most importantly, is actually the quality of the integrity, the quality of the person. What's their, how do they treat other partners? How do they deal with borrowers? How do they work out loans if an issue should arise? Integrity, honesty, being forthright, those are all traits that we look for and we value, both with our own investors and with our partners, and that's no different with originators. So what is the Yieldstreet due diligence process when you evaluate any new investment? I'd say first and foremost, it's very comprehensive. We are not taking exclusively what our partners are providing to us and just taking it as fact. We are doing our own verification, our own underwriting, as if we originated that loan ourselves. That would include multiple facets. First and foremost, all third-party reports: appraisal, phase one, property condition report, to ensure that all the major potential red flag items are highlighted. Second, we'd look at comparable sales. So we'd look at properties similar to the one we're lending on in the area and see where did those sell for, how long did it take to sell them, what was the price per unit or price per foot, and how does that compare to our loan basis. Secondly, lease comps. So if it's a multifamily property, if it's office, if it's retail, industrial, there are other leases that are being signed in that market. Where are leases at our existing property getting done? And where's the market? And are we above market? Are we below market? And where do we think cash flow will move over the life of that investment? That's probably another large component of our underwriting process. I'd say the sponsor evaluation is probably the most important decision when you make a loan to a partner. What's their background? What's their experience on asset class? What's their background check look like? Are they clean? Do they have a good credit score? Have they filed bankruptcy before? Have they given properties back? Do they have experience in construction, as an example, if it's a construction loan? If they don't, I'd probably steer away from partnering on that investment because I'm not confident that that borrower can actually complete the project on time, on budget, and as we would expect as a lender. So all of those factors go into our underwriting process to ensure that first and foremost, our investors' principal is covered and protected, and ensure we get paid back at the time we specify. What does the onboarding process consist of when we bring on a new originator? First and foremost is their track record. We look at the investments they've made in the last, call it 3 years, 5 years, 10 years, how those investments performed. Were there any defaults? And if so, had they handled them? Did they sell the note? Did they go through foreclosure? Did they work out a forbearance or a modification with the borrower? There's different ways that you can approach those topics. Some people are very aggressive and want to foreclose, take the assets back. That's not really our desire as lenders here at Yieldstreet. So we'd probably err on the partnership with someone who's more apt to work them out in a non-confrontational manner to get the optimal return for the investor base, as well as like processes. How do they keep track of their files? How do they perform due diligence? What do they look for? What do they focus on? How diligent are they? How close to the property they get? Do they do site visits? That's something that's very important to us. Going to see the asset with this specific person and going to check the asset out and look at, the locations, the layouts, competitors, the market dynamics, the walkability. These are all important things that one must consider when you make a loan or make an investment. And we want our partners to be able to not only know how to do that, but also go through and follow through with that. We go through third-party reports. We go through the legal process. So we see what kind of document packages does the originator utilize? Who's their law firm? What kind of package do they create, and how detailed is it? Is there a lot of leeway for the borrower to misinterpret or find holes in those documents, or is it pretty tight? Those are all things that when we onboard an originator, we look at, we focus on to ensure that our investors are protected. What excites me most about Yieldstreet's future, in particular with regard to the real estate sector? So when you think about the risk spectrum of real estate lending investment opportunities, you have safe, super secure Class A properties in prime markets, all the way to equity. The hope at Yieldstreet and what I see the future going is that we can offer our investor base the ability to access all components or parts of that risk spectrum. We hope to find a place to put capital to work for super secure first mortgage loans, sub 60% LTV at a 5% coupon. At the same time, we can continue doing our traditional bridge product, 8% plus 2-year terms on transitional properties. Moving to the equity space, we think that we could partner with best-in-class equity investors who have owned, operated, managed Class A properties and offer those investments to our partners and our investors on the platform. The goal is to spread out the risk parameters and offer out more product, and we hope to get there in 2020.